A high credit score isn't just a number, it's the key to unlocking financial opportunities, saving you thousands on loans, mortgages, and even insurance rates. Imagine getting approved for the best credit cards, securing low interest rates, and never worrying about loan rejections. But here's the problem: most people don't know how to build or maintain a strong credit score, and small mistakes can cost them big. In this video, we're diving into powerful credit card hacks that can instantly improve your credit score, whether you're starting from scratch or trying to recover from past mistakes. You'll learn how to optimize your credit utilization, remove errors from your credit report, leverage the power of authorized users, and even use secret strategies that top financial experts recommend. We'll also discuss common mistakes people make, like closing old accounts or applying for too many credit cards, and how to avoid them. Whether you want to qualify for a mortgage, finance a car, or simply boost your financial health, these credit hacks will put you on the fast track to success. So, stay tuned, take notes, and by the end of this video, you'll have a clear roadmap to improve your credit score and take control of your financial future. Your credit score is a 3-digit number that determines your financial credibility, affecting everything from loan approvals to interest rates and even job opportunities. But how is it calculated? There are 5 key factors that shape your score: payment history, which makes up 35% and reflects how reliably you pay your bills; credit utilization, accounting for 30%, which measures how much of your available credit you're using; credit age, at 15%, which considers how long your credit accounts have been active; credit mix, at 10%, which rewards diversity in credit types like loans and credit cards; and inquiries, making up the final 10%, which tracks how often you apply for new credit. While FICO and VantageScore are the 2 main scoring models, lenders rely more on FICO scores, typically ranging from 300 to 850. A higher score means lower interest rates and better financial opportunities, while a lower score can result in costly loan terms or outright rejections. Understanding how your score is calculated is the first step to improving it, and in this video, we'll show you how to optimize each of these factors to boost your creditworthiness. Paying on time is the most crucial factor in maintaining a high credit score, as payment history makes up 35% of your total score. A single missed payment can stay on your credit report for up to 7 years, making it harder to get approved for credit cards, loans, or even mortgages. To avoid this, set up automatic payments for at least the minimum amount due so you never miss a deadline. Use calendar reminders, budgeting apps, or alerts from your bank to keep track of due dates. If you do miss a payment, act quickly, contact your lender immediately and ask if they can waive the late fee or remove the delinquency, especially if you have a history of making payments on time. Many lenders are willing to offer a one-time courtesy adjustment. Additionally, consider making multiple smaller payments throughout the month rather than just one big payment before the due date. This can reduce your credit utilization and help keep your score high. Even if you're facing financial hardship, never ignore your bills. Reach out to creditors to discuss options like payment plans or hardship programs to prevent negative marks on your credit. Paying on time not only boosts your credit score but also saves you from costly interest charges and penalties. Consistency is key. Staying disciplined with your payments will ensure long-term credit health and financial stability. A strong credit score opens doors to better financial opportunities, lower interest rates, and easier approvals for loans, so prioritize paying on time to reap the benefits. Your credit utilization ratio, how much credit you're using compared to your total credit limit, makes up 30% of your credit score, making it the second most important factor. To maintain a high score, aim to keep your utilization below 30%, but for optimal results, stay under 10%. If your credit card limit is $10,000, try not to carry a balance above $3,000 at any given time. One way to lower your utilization is by paying off balances before your statement closing date rather than just making the minimum payment. This ensures your reported balance stays low when creditors review your account. Another effective strategy is requesting a credit limit increase from your card issuer. If your limit increases but your spending remains the same, your utilization drops, improving your score. Additionally, consider making multiple payments throughout the month to keep your balance low. If possible, spread your expenses across multiple cards instead of maxing out one, as high utilization on a single card can negatively impact your score. For those with high balances, transferring debt to a lower interest card or paying off a portion of the balance with a personal loan can also help manage utilization. Avoid closing old credit cards, as this reduces your overall available credit and increases your utilization ratio. Staying proactive in managing your credit usage ensures a stronger score, lower interest rates, and better financial opportunities in the long run. Becoming an authorized user on a well-managed credit card can significantly boost your credit score, especially if you have a limited or poor credit history. When you're added to someone else's account, such as a parent, spouse, or trusted friend, you benefit from their positive payment history and credit utilization without being responsible for the payments. The key is ensuring the primary account holder has a strong credit history, low utilization, and a long account age, as these factors will be reflected on your credit report. However, this strategy comes with risks. If the primary cardholder misses payments or carries a high balance, it could negatively impact your score instead of improving it. Always communicate with the account holder and monitor the account to ensure responsible usage. Additionally, not all credit card issuers report authorized users to credit bureaus, so confirm this before proceeding. If done correctly, this method can quickly boost your credit score, making it easier to qualify for loans, credit cards, and better interest rates. However, it's not a long-term solution. Use this as a stepping stone while building your own credit responsibly through on-time payments and smart credit usage. The length of your credit history plays a crucial role in determining your credit score, making up about 15% of your overall rating. Many people make the mistake of closing old credit accounts, thinking it will improve their financial standing, but this can actually hurt their score. Keeping old accounts open, even if you no longer use them frequently, helps maintain a longer average credit age, which signals stability to lenders. When you close a credit card, you not only shorten your credit history but also reduce your total available credit, which can increase your credit utilization ratio, another key factor in your score. If an old card has no annual fees, consider keeping it active by making small purchases and paying them off immediately. This keeps the account in good standing and prevents the issuer from closing it due to inactivity. However, if a card has high fees and you're not using its benefits, it may be worth closing, but only after considering how it will impact your credit profile. Ultimately, maintaining older accounts responsibly is an easy way to strengthen your credit score over time without any extra effort. Errors on your credit report can drag down your credit score without you even realizing it. That's why regularly reviewing your report is essential. Start by getting a free copy from major credit bureaus like Experian, Equifax, and TransUnion through annualcreditreport.com. Look for mistakes such as incorrect personal information, duplicate accounts, late payments you actually made on time, or accounts that don't belong to you. If you find an error, dispute it immediately by contacting the credit bureau and providing supporting documents. Many disputes can be resolved online, and bureaus are required to investigate within 30 days. Removing inaccuracies can give your score a quick boost and prevent lenders from making decisions based on false information. Even a small correction can mean the difference between getting approved for a loan or facing higher interest rates. Stay proactive, check your report at least once a year and take action if something looks off. A secured credit card is one of the best tools for rebuilding or establishing credit, especially for those with low or no credit history. Unlike traditional credit cards, a secured credit card requires a refundable security deposit, which typically becomes your credit limit. The key benefit is that responsible usage, making small purchases and paying the full balance on time, gets reported to credit bureaus, helping to build a positive credit history. Many secured cards, like the Discover It Secured or Capital One Platinum Secured, even offer rewards and opportunities to graduate to an unsecured card after demonstrating responsible use. When selecting a secured card, look for one with no or low annual fees, a reasonable deposit requirement, and the ability to upgrade over time. To maximize the benefits, keep your credit utilization low, ideally below 30%, and always make payments on time. Consistent responsible usage can significantly boost your credit score within 6 months to a year, making it easier to qualify for better credit cards, lower loan interest rates, and increased financial opportunities. Some secured cards even offer perks like cashback rewards or automatic credit line increases after a few months of on-time payments. While it may seem like a slow process, using a secured card wisely is a proven way to rebuild credit and unlock better financial opportunities in the future. It's an investment in your financial stability, giving you a stepping stone to access better credit products without the risk of falling into high-interest debt. Every time you apply for a new credit card, loan, or mortgage, the lender performs a hard inquiry on your credit report, which can temporarily lower your credit score. Hard inquiries signal to lenders that you're seeking new credit, and multiple inquiries in a short period can make you appear risky. In contrast, soft inquiries, such as checking your own credit score or pre-qualification checks, don't impact your credit at all. To protect your score, limit hard inquiries by spacing out credit applications at least 6 months apart and only applying for credit when necessary. If you're rate shopping for a mortgage, auto loan, or student loan, credit scoring models like FICO and VantageScore treat multiple inquiries within a short period, typically 14 to 45 days, as a single inquiry, minimizing the impact. Another way to reduce unnecessary hard inquiries is by using pre-qualification tools offered by banks and credit card issuers, which allow you to check for approval odds without affecting your score. Additionally, avoid applying for credit impulsively. Store credit cards, for example, often come with high interest rates and minimal benefits but still generate a hard inquiry. Keeping your inquiries low ensures that lenders see you as a responsible borrower and helps maintain a higher credit score, which is crucial for securing better interest rates and financial opportunities. Achieving a perfect credit score requires more than just the basics. It's about optimizing every aspect of your credit profile. One powerful strategy is using credit builder loans, which are specifically designed to help those with limited credit history establish positive payment records. Another trick is making bi-weekly payments instead of monthly ones, which reduces your credit utilization and results in more frequent positive reporting to credit bureaus. Additionally, if you have existing debt, consider negotiating with creditors for lower interest rates or settlements, which can make repayment easier and improve your score over time. Diversifying your credit mix by responsibly managing different types of credit, such as credit cards, installment loans, and retail accounts, also strengthens your profile. Regularly monitoring your credit report ensures you catch errors early, and using tools like Experian Boost can add on-time utility and phone payments to your credit history, giving your score an extra lift. Finally, patience and consistency are key. By maintaining good habits and avoiding common mistakes, you can gradually work toward an excellent credit score, unlocking the best financial opportunities. One of the biggest mistakes people make with their credit score is maxing out their credit cards. High credit utilization signals lenders that you might be financially overextended, which can drastically lower your score. To avoid this, always aim to use less than 30% of your credit limit and pay down balances frequently. Another major pitfall is missing payments. Even a single late payment can stay on your report for years and significantly impact your score. Setting up automatic payments or reminders can prevent this costly mistake. Applying for too many credit cards at once is another red flag for lenders. Each hard inquiry can lower your score, and multiple applications in a short period make you appear desperate for credit. Instead, space out applications and only apply when necessary. Closing old accounts is another common mistake. Length of credit history is a key factor in your score, so keep older accounts open to maintain a longer average account age. Additionally, ignoring your credit report can be a silent killer of your credit score. Errors and fraudulent activity can damage your score without you even realizing it, so checking your report regularly and disputing inaccuracies is essential. Another risky habit is only making minimum payments. While it keeps your account in good standing, it also leads to prolonged debt and high interest payments, making it harder to maintain a healthy credit profile. Lastly, failing to diversify your credit mix, such as using only credit cards without installment loans, can limit your credit growth potential. By avoiding these mistakes and staying proactive with your credit management, you can build and maintain a strong credit score, opening doors to better financial opportunities. Boosting your credit score doesn't have to be complicated. Here's a quick recap of the best credit hacks to help you build and maintain a strong financial profile. First, always pay your bills on time. Payment history is the most significant factor in your credit score, so set up automatic payments or reminders to never miss a due date. Second, keep your credit utilization low by using less than 30% of your available credit. If possible, pay off balances early or request a credit limit increase to improve your ratio. Third, become an authorized user on someone else's credit card with a strong history. This can instantly boost your score by adding positive payment history to your report. Fourth, keep old credit accounts open. The longer your credit history, the better, so avoid closing old accounts unless absolutely necessary. Fifth, regularly check your credit report for errors and dispute any inaccuracies you find. Even small mistakes can impact your score, so staying on top of your report is crucial. Sixth, consider using a secured credit card if you have bad credit or are just starting to build your credit history. These cards require a deposit but help establish positive payment behavior. Seventh, limit hard inquiries. Too many credit applications in a short time can lower your score, so space out new credit requests wisely. Eighth, take advantage of bonus strategies like paying off debt twice a month, negotiating lower interest rates, and using credit builder loans. Avoid common mistakes like maxing out cards, making late payments, and relying only on one type of credit. By following these steps, you'll be on your way to a higher credit score and better financial opportunities. Take action today and start improving your credit. Like, subscribe and comment. What's your current credit score goal?